On today's show, 3 questions. Number 1, why is no one talking about the Japanese yield curve? Number 2, should I buy a car right now? And number 3, is the American dream dead? Welcome to Dentist Money's 2 cents, where we have dentists navigate all the noise. I'm Matt.
Taylor, and I'm Rabih.
Yeah, you are, Rabih. We did a week without you, Rabih, and it was too much.
What's
That's
up?
as much. From now on, you are only allowed to go away for a week. That is
Okay.
it. You cannot miss more than 2 cents. We missed you. We're glad you're back, and all is
Miss you
well.
too, guys. I
Yeah.
actually listen to it overseas, as I usually. It's become like a yearly tradition. I put 2 cents because I'll be jet lagged, and I'll put it and fall asleep to your voices. It's
Yeah.
amazing.
That is not something you want to do. I never recommend falling asleep to my voice, but yeah, it was actually fun. You messaged me while you were gone, and you were like, "I listened to 2 cents," like, and I was like, "Did we do okay?" Like, you weren't there.
No, it
You
was great.
signed off on the show. You said we did a good job. You signed off.
Yep.
So let's actually start with this because you said something before we got on. This is not part of our questions, but kind of to pick up where we left off, we talked about the downgrade of the U.S. and gave the history there. Now, for the first time ever, all 3 agencies have downgraded the U.S. The first thing you said when we were going to talk about the Japanese yield curve, which we're going to, you said, oh, and by the way, it does not matter that they downgraded our debt. Do you want to start there really quick, just to like give your opinion on that?
Oh yeah, it's not something new. The first downgrade happened in 2013 during the Obama administration. Back then, it was a big deal because it was the first time we're downgrading from a AAA to a AA rating, right? And then a couple of years ago, if I'm not mistaken, after COVID, I think 2022,
I think it was 22 or 23. Yeah.
S&P also, so Fitch started it. S&P did it in 2022, and now Moody's, or did I mix them up?
No, I
Anyway,
think you're right. So I think it was S&P first, then Fitch, and then Moody's was
Fitch
just recent.
and Moody's just recently just kind of agreed with the 2 other ones. So if 2 out of 3 were saying it's a AA rating, and now 3 out of 3 are saying AA rating, okay, so what additional information does this add to the market? Already the majority said it. Had they came in and say, oh no, the US is AA minus or an A, then
Below investment grade or something.
yeah, then we would be in trouble. You would expect interest rates to skyrocket. The spreads between corporate bonds and treasuries would go in directions we haven't seen before. But we are still far away from that. The argument for these papers and this analysis has been the same argument it's been for the last decade: unsustainable fiscal path for the U.S., adding to it political instability or political tension, partisanship. On top of that, high interest cost. All of these are a recipe for default on the long run, but hopefully the US can figure a way out of it in the future through either outgrowing their debt or some austerity measures, which, a
We got to
different
do
conversation.
something.
Yep.
We got to do something because at some point, like this is not the topic of today, but just in general, at some point, we got to be, I think, thinking like, we can't just keep racking up debt, which we just every single year since 1998 we just continue to do. So I've kind of been in the camp of for a long time of like, it doesn't matter, we'll be fine, which I still think we will be fine, but at some point I think it does kind of like, okay, we need to make this probably top of the list of things to figure out. So, and it doesn't seem like the big beautiful bill is actually going to be the answer there, because it's adding all trillions of debt to the or adding trillions of dollars to it over the next 10 years. So that doesn't seem to be the answer either.
100%. And I feel like in that election, part of the reasons for why the Republicans were able to win over Democrats is because there was a promise for better, fiscal responsibility. We'll see how it pans out. The market is I'm going off a tangent here, but it's like very Milton Friedman in that sense. It's like, yeah, who cares about the long run? We're all dead in the long run. That's the famous quote. So what matters is right now. And you see, like, as taxes are being cut or as trade deals are being written, although they're not being built up from the ground level with the intention to reduce that in the long run, they are still getting welcome. And the markets are rallying based on these news, although they are short-term wins rather than long-term wins. We'll see. We have so many other 2 cents episodes to cover this.
I was going to say, that is not what we wanted to talk about today, but I just wanted to get your take, because you said the downgrade doesn't matter. And I'm like, oh, great, let's throw that in. So let's start with, why is no one talking about the Japanese yield curve other than us, Rabih?
Yeah, I think people are distracted by the credit rating, or distracted by the earnings, or distracted with, the very temporary tariffs, 50% tariffs on the EU that was then revoked over the weekend, or the news that China is not cooperating on the free trade deal agreement. All of these stuff are swaying the market up and down, but there are stuff that happen at the surface level. And then there are stuff that happen in the depth that have important systematic impacts on financial markets. And that one is not coming from the US, actually. It's coming from Japan. So let me just tell you a little bit about it. For our longtime listeners, I think they're on the same page. But for people listening to us for the first time, Japan has a very different demographic to the US. They are an old, aging population. Their economy boomed so much in the 1980s. Imagine like China now with its roaring power economically. Japan was like this. And then they faced a huge credit bubble and a real estate bubble that took the economy down. And because they didn't have the young demographic to reignite the economy, kind of struggled and stagnate over the term. Add to it cultural aspects and the way monetary policy was determined. They went since the 80s, from 1980s till now, into this stage where we control interest rates, we leave them slow, we keep growth under control at a slow pace, and we keep inflation grow slow at a slow pace under control. And that means probably the rest of the world will actually go past Japan in economic growth. And this is what happened. It dropped from being the second largest economy to the world to now being in the top 10, but it's much lower. So this is where Japan has been. And because of the aging demographic and the fact that the country has lots of debt, we are at 130% GDP, debt to GDP ratio of the US. Japan is 250, 256. So they are the most indebted developed country in the world. And actually, if we want to extrapolate and go into hyperboles and say, oh, what if the US keeps on taking on so much debt and we stop, either making babies or letting people immigrate, that's the fate. The fate is that the economy, it's not going to crash and disappear. It's just going to be very slow,
It's going to be a
not moving
slow
the boat.
bleed.
Very, very slow bleed. So this is what happened in Japan. And the government, due to its high amount of debt, does not want interest rates to go up, because that means they will have to pay more interest payments, and they have obligations, social security, etc. However, in 2022, as inflation went rampant throughout the whole globe, Japan included, the interest rates start going up. And the Federal Reserve, not Bank of Japan, the Bank of Japan decided that they want to do some tightening monetarily by allowing interest rates to go up. So the interest rate in Japan, and by the way, Japan borrows not just like the US on 10 years, 20 years periods, but they have 30-year bond, 40-year bonds. So the 40-year bond in Japan, let me pull it up, actually increased. The data I have, it's always been around like 2%. And it has skyrocketed from 2022 until last week, where it reached a high of 3.1%. And that is huge for Japan. The last time, like not in the 21st century, like we haven't seen interest rate like that in Japan. This is problematic. This is scary. So how is that systematically important to US investors? For the Japanese people, it just means, okay, now your government, if it needs to refinance its debt, it's refinance them at higher prices, and probably cost of borrowing in Japan for Japanese consumers is higher, especially if you're buying houses, etc. But how does that connect to the US markets? How does that connect to equity markets? The fact that Japan has been chronically in low interest rates environment allowed international investors to leverage. What they do is carry trade. What happens is that if Japan is only requiring 2% out of you, but if you invest it in US Treasury, you can get 4% back. All the big players, and we're talking bond market here, pension funds, endowment funds, sovereign funds, are going to be borrowing in Japanese yen, converting them in US dollars, and then investing in US Treasuries. And they would make a 2% spread, because you borrow at 2%, you invest at 4%, and there's no risk in there. It's government bonds in both countries. Now, as interest rates in Japan are going up, that spread is getting lower. And from investors' perspective, they're not going to be making 2%. They might be making 1%. And because of that volatility, now currency risks add to it. It might not be even good to invest, to do that trade elsewhere. What this means that a lot of money is going to be going back to Japan. A lot of money will be leaving international markets. And what has been the superhero of capital markets for the last 20 years has been the US, especially large cap tech. So that means that there's going to be less money flowing into the US going forward, given the economic landscape in Japan. And this actually might prompt US investors to start investing more in Japan, just because now you can get higher yield than you used to. So the flow of money is, I wouldn't say it's completely reversed course, because there's still money coming into the US between these two countries, but the flow of it has definitely started to become thinner. And that means that it's not that whenever the market dips 10-15%, you'll find global investors funneling in, buying the dip, elevating the US equity markets. Now it's going to be more, let's see your numbers, let's see if you're a business that makes money, and let's see whether you deserve money be put in during a crash to capitalize on investment opportunities. It's healthy long run, but those are big tidal moves that we should be aware of. And it is important. I don't know if you remember 2 years ago when a new government, Liz Truss in the UK, came in and they had a fiscal policy that wrecked markets for 2 days, especially in the UK. This is at that scale, but it's happening slowly, and it's something to monitor. That is what's important.
Well, I know Taylor's monitoring it. Most of his portfolio hinges on the Japanese yield curve. He's really active in it, right?
Yeah, if you're not shorting the Japanese yield curve right now, I mean, I don't know.
I don't know what you're doing then. No, it just makes me think kind of like generally, Rabih, I was listening to a podcast about what the big beautiful bill. I was trying to learn more about that, and they were talking kind of just generally about where we are as far as the deficit and the debt that's growing and the projections that the COB is making with the big beautiful bill, and like what this looks like in the next 10 years if they put this through without any like changes, which I think it's still very up in the air. If the Senate passes this, there's some holdovers on the Republican side. I think could be tough. But I'm just sitting here thinking as you talk about like this slow bleed, I think the biggest reason at some point I think we have to put this to the top of the list. Like this should be, meaning the debt and the deficit and everything, is when you're going through that, I'm sitting here thinking like all we're doing right now is just adding to the list of things that could go catastrophically wrong. Right. And with this debt and with the deficit and the debt growing every single quarter, every single year, they talked about this on this podcast of like, I heard this one economist say, we're at a place right now that like one bad inflation reading or like one bad piece of data, because we've kind of stacked the deck against ourselves right now, and it continues to be the case, things could be fine for a lot longer. Things could just keep chugging. And Rabih, you're saying we could get to a place of, it sounds like you're saying like Japan being an example, like we still have room to grow or to go as far as the debt goes. But what worries me is like destruction can happen really fast, right? It's like this slow bleed, slow bleed, slow bleed. And then all of a sudden one thing changes or works against you. I guess the bottom line is like, I'm just sitting here thinking like we're losing options every single day, every single quarter, every single year we let this go without doing something about it. Is that a fair kind of like way to look at this?
100%, 100%. If you leave it as it goes, the way the stream is flowing, it's heading towards a waterfall. It's important to try to like divert direction. Actually, economists don't even know what's the right path forward. And every administration that comes, they want to solve this issue, but they have contradicting. At the end of the day, market forces are gonna dictate this. Who has the money to consume will have a say. Who has the manufacturing power will have a say in it. What technologies dominate and how do political advantages change will dominate. Like this is bigger than one administration trying to determine it. But if your fundamentals are correct and are tight, and you're running a well-run ship where you're not just existing and spending, you're going to be in better position than someone who does. That is, you just go back. We don't know what the future is going to be like, but it's like a sports game. You do not know how your opponent is going to fare, or whether you're playing football outside and it's going to start snowing on you. You do not know. But if you've been practicing well, you are been training, you are not sleep deprived, aka that in my analogy, you should be able to weather the storm and survive.
Yeah, it's almost like I think we have like an overall like psyche problem in America from the government on down, meaning it's all about spending. Our entire psyche, again, government included, by the way, on both sides. I don't want to hear either one say they spend less than the other. They both do. They both add to the deficit, administration by administration by administration, from basically the beginning of the 21st century on. That's all they do is add to the deficit, both sides. But it's almost like a psyche problem right now. It's almost like because we're just so consumer focused and so spending focused, both government and individuals, it's like we all kind of like say it's a problem. Like, yeah, it's a problem. But it's like, well, no, but like it's a real problem. Like this is something we have to address. And every administration just comes in, says a lot of nice things, and then continues to kick the can down the road. Like that's probably the biggest thing that I think anyone listening to the show knows. Like I'm certainly not a doomsdayer, and I'm not even saying this is a doomsday scenario. but I'm starting to kind of wrap my mind around this idea of like, this is becoming pretty urgent, I think. Like, we've got to do something about this. And I don't know how we do that because I don't see either side really actually doing anything about it. And COVID only made this worse, right? Our post-COVID spending has not gone back to pre-COVID. Like I think the government saw that as an opportunity to just be like, ratchet this up even more. And we're spending right now as if it's still COVID. And it's crazy. So let's get Taylor in here and bring me back down to earth.
Yeah, I mean, I don't know what else to add to that. Economists don't know, political parties don't know, we don't know. That's the thing with the market. Like anybody who's out there that claims that they know what's going on or what's going to happen is just selling you something, right? This stuff is too big. We're too big of a globally connected economy, market. Everything is influenced and connected in some way, shape, or form that it's just like anyone who's out there predicting or claiming they know what's going to happen doesn't. And we're all just kind of throwing darts at the board and trying to figure it out and creating stories and narratives around what we see. But if you're going to listen to anybody, I think Rabih's the one, right?
I could not agree more. Could not agree more. Totally. Rabih, anything else you want to add to this? Go ahead.
Yeah, I'll just bring it full circle. And it is like, even if the herd, us as a country, are probably heading in a direction that is not the most optimal, although it could be a viable path, but it's not the most optimal. This does not mean that you as an individual have to share that fate. Maintaining a healthy saving rate, making sure that your portfolio is diversified, is not concentrated in a single thing that can blow up, and making sure that you are focusing on your dental practice and you've got a healthy stream of income that's coming in that's not going to be easily affected by factors outside of your control, is gonna, like, life goes on afterwards. There's going to be a crisis. It's going to be a slap on the face. We do not know when, but the debt crisis of the US is a big one. We do not know when. This does not mean that you can't withstand it, but you have to make sure that you have everything in place to do so.
Yeah, love that.
Such a good point, Rabih. And it's really like you should be mainly focused on your own personal debt crisis, right? But irregardless of what's happening in the overall economy and the US, it's like you don't want your personal debt to balloon to a certain level, right? And I see that way more often than when we see something bad going on in the US, right? So to Matt's earlier analogy, when you are messing around with debt and getting higher, like you can ride the wave and you can let things go, but you're just losing options of like, if things do go wrong or if life does throw you a curveball, you're losing the capacity to weather that storm, the more debt that you incur. And that happens more with our clients than we probably care to admit, between student debt, practice debt, homes that are too big, car loans, consumer debt, you name it, right? And that's really what you should be focused on despite all the noise.
Yeah, I think it's a really great point by both of you. Let's acknowledge that this is a problem, and it is. It is a problem. I don't think we have to, again, we don't need to get doomsday and say this is the end of the world. We're not there, but it is something to acknowledge. But on the other side of it, to both of your points, it's what can we actually control, right? What can we control? Well, if we talk about what we can control, or the things that we have control over, of like at the macro level of what we're highlighting here, of like this debt and the deficit, the way you control that, or the only thing you can do, is control it with your vote. Like figure out, is there truly, like, right now it's tough because it's like, if this is not, let's say you agree this is the number one priority to fix, it's how do we find someone or a group that's actually going to dedicate themselves to actually fixing this? That's tough. So you only have so much control there. What you can control, to both of your points, is your own life, how you're approaching debt, everything you just said, perfectly said. So I like that, of just having that kind of running in the background. Can I control this? No. Okay, let's acknowledge it. Then turn your attention to the things you actually can control. Because if you let yourself go crazy with this kind of stuff, the doomsday, the news right now alone will make you go nuts. It is wild if you just like flip through headlines. So I think it's a really good point. Rabih, anything else you want to add to the Japanese stuff or any of the stuff we're talking about now before we're moving on to?
No, it's fine. It's nothing to be worried about with Japan, but this means that the infrastructure is changing, and what used to happen might not happen in the future.
Yeah, it's good to know. It's good to be thinking about that. Okay, let's jump into Taylor's topic. We fully admit, he admitted to us before we went on, this is totally selfish of Taylor. So we appreciate you acknowledging that, using us as your own personal advisors and maybe just therapy group. But let's go to Taylor about, should you buy a car right now? This was a specific question you have for your life. So let's talk about
Yes, yes. So, I think this question, as selfish as it is for me, and literally, I'll give you some more story behind it. I just wanted to talk to Rabih about it after everything I went through yesterday. Shelby and I have been we've been on the hunt for a new minivan for 2 years. And I'm sure everyone listening to this is also similarly in the hunt for a new minivan, right? Or something similar, right?
But what are we looking at though? Like what are we down to certain brands, what are we looking
Yeah,
at?
so here's the problem is the minivan is incredibly practical, functional. So the best kid vehicle. However, let's be honest, it's not the most attractive looking thing that's on the market, right?
Ever seen the Kia Carnival, my guy?
So that's where it comes in. The Kia Carnival is they don't even call themselves a minivan. They're calling themselves an MPV, which
Branding by
I
them.
think stands for like multi-passenger vehicle. Yeah,
It's like we're not a normal mom, we're
not
a
a
cool
van,
mom.
MPV.
Yeah.
But it's trying to look like an SUV. So Shelby and I, we're trying to like thread the needle of having like a practical minivan, but I also like to mountain bike. I like to e-bike. I have certain like racks and things that I want to tow. And so it's like, do I get the big SUV? Do I get the minivan? Do I get the car? But we've been circling this purchase for 2 to 3 years. And in the last 2 to 3 years, car prices have done nothing but go up. And then specifically this year, we've had all of this tariff noise, right? And on April 3rd, there was specifically an automotive tariff that was going to be 25% of imports that was put in place, right, or proposed. Since that time, there's been multiple court cases trying to block several different tariffs. I mean, it's at this point, it's like too much to even like pay attention to everything that's going on with tariffs. And there's just a lot of noise, but a lot of that like initial 25% tariff has been stripped back, and it's being fought over in court if it's going to hold up or not. Right. So originally, when that 25% tariff was announced, most industry experts were saying that cars were going to increase in price from $5,000 to $15,000 on average. But since that time, and since those things have been stripped back as recently as May 28th, so 2 days ago from when we're recording, there was a court ruling that left certain aspects of the tariff in place and is still blocking certain others. But that 5,000 number is now dropped to 2,500, is what they anticipate the cost of cars will go up by, at least by the end of this year. And in April alone, we saw the average car price go up by $750 just in that single month. So there's been movement on the price, and we're seeing more movement. But specifically with me and my situation, we've been looking at buying this van for 2 years, and we went and made the mistake of actually going into a dealership yesterday.
Oh,
The buzzword was tariffs, tariffs, tariffs. They were talking about the prices.
now.
You got to buy now. The 2026 models are coming up, and you know the prices are going to be more expensive. And I was like, is this just sales speak? Am I just talking to a salesperson that's at the end of the month and wants to hit their quota and get their bonus, right? Which there's probably some of that. But after going through this and spending time researching this yesterday and today, this is not just noise that's happening at the car salesman level. This is happening, Ford announced this and said, hey, we fully anticipate that we're going to have to increase prices. The current inventory, we haven't had any increase on, but we anticipate that we're going to see this, right? So Ford's come out and said that. Honda's come out and said that. Like a lot of these big manufacturers are indicating with the increase. And that's the thing about cars. It's not just cars, it's the price of steel. It's the batteries, it's the components that go into the car. There's a lot of different features within the car that are affected by the tariffs, which in turn causes the price of that to go up and then the overall car to go up. So that's kind of the backstory. That's my worries. I'm sitting here like, gosh, do I have to pull the trigger on these Memorial Day car sales before the new models come out and the prices and the tariffs go up? And so I wanted to ask Matt and Rabih, who are my like go-to sit through the noise.
It's funny because you are to me the same. Like I go to
We
Taylor.
are just each other. Yeah, this is very kumbaya.
And
Yeah.
I want to say, is there any truth to this? Is this actually happening? Are cars like, is it actually better to get a car now and the caveat is if you're in the market for a new car, right? Like don't just go out and buy a new car to buy a new car. But if you're actually looking at this, is there any sense in getting this sooner rather?
Could I first just say, when you said I was in the dealership yesterday, I kind of shuddered a little bit. I kind of like tightened up. I was just like, oh, is there any, it's a bottom three experience of life, right? Of sitting in the dealership. at least I've had some bad experiences at the dealership. It is not my favorite thing. They take your keys, they won't give them back. Let's bring this other guy in. You can talk. I hate it so much. So hopefully it went okay for you.
Yeah. Fortunately, I had the excuse because the reason why we were there is the sliding door on my current van went out and there was
So they were fixing it.
and they were fixing it. So any salesman
Got it.
came up to me, I was like, "Oh, I'm here for service. I'm here for service." Right. But because I was sitting there for my van to get fixed, I was like, I got to go ask. I want to see what these Carnivals are worth. I want to see what the Pacificas are worth. What am I looking at? But yes, I did have an out. So fortunately, it wasn't the whole runaround experience.
That's good. So let's turn to Rabih. Rabih, is there validity to this from a macroeconomic perspective? We just said in the last segment that we can't predict these things, and anyone trying to sell Taylor a Kia Carnival. But is there any validity to timing this if he's already in the market?
The way I'm thinking of it, there are two opposing narratives. And because each has an opposing effect, it's noisy and you can't know what the outcome is. Like, this is upfront what it is. But the first narrative is tariffs are there in place. They will increase the cost of raw material, aluminum, copper, steel, etc. That will make cars more expensive. They'll pass that on to the consumer. End of story. Also, if it's created out like Kia's South Korea, right? So there's going to be an import tax on that, a tariff on that. So that will increase the price. That is there. The counter argument for this narrative is that those tariffs are very fragile, and whether they're going to be going in effect or not depends on whether a trade deal shows up, whether a federal court blocks it. All of that is there in limbo. The other point of it, and we have seen it in industries outside the US, outside the car industry, is that travel in general is becoming cheaper. Like flight prices are cheaper. Global economy is expecting a slowdown elsewhere, and that is making prices cheaper overall. This reflects on cars because cars are very cyclical. So you've got one narrative that's saying prices will go down because the economy is slightly slowing down. And another one is saying, well, there's going to be price pressures due to political impact. Which one overwhelms the other? I do not know. I really do not. And in that sense, maybe we should shift the perspective about it's not about what the car is worth, but how much of a need it is right now and versus how much of a need it is later on. Like if it breaks down, you might have to do a flash buy and you might be hurt by a price. Whereas now you have the luxury of time. I think something about cars, this is my personal opinion, they're not all identical. It's not like a stock. A share of Apple is a share of Apple everywhere. A car is an individual security and every single car is going to be different. There might be an overall trend upward or downward, as we just discussed, but this does not mean that there's going to be a certain undervalued security out there or a good catch of a car if you search enough. So I think it's going to be a car specific thing rather than a macro specific thing. As for the dealer, I just want to throw this in because he got under my skin. The car dealer, they had a really good March. They had an incredibly good March. Retail sales were up 1.5% between month over month. It's usually like 0.1 up, 0.1 down month over month. They had a 1.5% increase between February 2025 and March 2025. And most of that was driven by car and retail sales. And I pulled it up for April. And April came in at a total of negative 0.1. So it went back to the trend really well. And auto kind of was a little bit negative too. So can I make a case against them saying that, hey, they had really good numbers in March and now their sales manager is trying to push them to keep them or to even surpass them while the market reaction dissipated and went back to normal properly? I think that there's a big conflict of interest listening to what the car salesman is saying and look at it more from macroeconomic perspective. If you expect that the tariff situation is going to ease and we'll probably have a global economic slowdown, waiting might be in the books because that means lower prices. If we think that we're just going to have a booming summer and then tariffs are going to stay in place and it's going to be tricky because negotiations are going to take longer than we thought, then probably those new models will come at higher prices. But do you really want to predict the global economy through your car? This is what I want to ask.
This is what I wanted to ask you, Rabih. I
wouldn't. I would just.
I wanted you to tell me if this is smarter, if I should wait. What you're telling me is no, you don't know, which is disappointing.
No, I don't know, and I think you should look at. your need for a car. How much of an extra additional cost would it be if you waited and you had to rush to buy another car versus buying one now?
Yeah, I've got not much to add on what Rabih said, other than just from the personal finance perspective. I agree with Rabih. Like, if you and Shelby have been talking about this for a couple of years, it seems like it's time. It's like timing the market. Like, it could go either way. You have no idea. So I think if you can afford the car, you find the right one, Kia Carnival, obviously, an MPV or whatever they call them. I don't think there's going to be any reason why you'd wait unless, again, your personal circumstance accounted or required you to wait.
What's going through your mind? You're like thinking. I want to know what's going
No,
on there.
I tongue in cheek said I was doing this selfishly, but honestly, I've heard this from a lot of clients, right? I've got a lot of clients who are buying cars. I think there's a lot of people out there listening that are probably having similar feelings. I think if you go back to March, one of the big reasons why March was such a good sell is because these tariffs were announced and people were the height of that worry was in March. And so there was a lot of people getting pushed over the hill of like, oh, I need to go ahead and buy this new vehicle before these tariffs kick in, right? I mean, look at April and the reaction in the stock market to the tariffs. Like there was just a lot of reaction happening to the tariff news. And I think there was a lot of fear out there and that still exists. And my hope by like bringing this to light more than anything was to just temper that in people, temper that fear and being like, hey, if you're like feeling pressure to go ahead and bring the car purchase up earlier than you were anticipating, you don't need to do that. Like, that's not like you have to do this or you're going to miss out, right? The purpose I was hoping here is to like calm people's fears when it comes to buying cars that like, hey, it's okay. Like the most important thing here when it comes to buying a car, as you guys have both said, is it the right timing for you and your family? And if you can afford it, right? And if the monthly payment makes sense and it's what you need for your family, it does not matter what happens with the price of cars after you've purchased cars.
So true. Yeah, that's a really good point. Stop tracking prices after you buy the car. You're just going to drive yourself crazy. The other thing I'd say just on the tariffs, insert tariffs for now, but it could be anything. But let's take the tariffs as an example. The amount of changes we've seen on headlines of like, this tariff's this, and now it's down 50%, and now the Supreme Court's blocking it. And like that alone makes it really difficult to say what's going to happen with these things. And then not only that, the impact it's going to like trickle through, how it's going to impact the economy and when. And so, yeah, I think it's a pretty straightforward, if you can afford it, it fits in your budget, it fits for your lifestyle, buy it. And don't try to time. You're going to drive yourself crazy trying to time these things, trying to optimize.
And I did last night, stayed up 1:30.
And you are driving yourself crazy. Anything else, Rabih? Anything else you'd add or Taylor, anything else you want to add to the car discussion? Taylor, did we satisfy your selfish needs to get some advice on the show?
Not really. I was hoping Rabih was going to give me some like real
He was going to give you a date of purchase.
information. Like, hey, I've been over in Europe for the last 2 weeks, and I heard through the grapevine. I was hoping for some of that.
I think you should bring Rabih to the dealership with you when you go to buy. He'll be your personal.
I'll get a restraining order. They won't let me in anymore.
I've told Rabih I want to take him with me on my family Disney trips, just so he.
It'd be amazing.
That's why he's getting a bigger car, just so he can fit me in there.
Fit Rabih. Exactly. Okay, let's move on to the final segment here. Kind of I was thinking about this ever since our last week when we talked about housing specifically, but question being, is the American dream dead? I found this article after we did that segment, which was a great topic that Jake brought. And he wrote about, like, is the housing market broken, basically. And then Nick Majuli, friend of the show, not really, we always say that, but Nick Majuli, he works for Ritholtz. He has a great blog called Of Dollars to Data. Highly recommend it. He wrote an article titled, Has the American Dream Become Unattainable? So let's first start with the definition. Well, I didn't know this, but where the American dream was coined initially, Rabih probably knows this, but just because you're our resident historian. So where it was coined and kind of what we're talking about, kind of setting the premise of what we're talking about with the American dream. So the American dream, as written by Nick Majuli, it was first coined by James Truslow Adams in 1931. He wrote a book called The Epic of America, and basically was writing around like talking about these ideas around the nation's founding, and this main kind of belief being that individualism, self-reliance, and land ownership are kind of the central kind of ethos of American life. If you get even more specific, kind of to the maybe a little bit more modern day, the American dream is defined by Investopedia as the belief that anyone, regardless of where they are born or their socioeconomic status, can attain their own version of success in society with upward mobility. Upward mobility is possible for everyone. The American dream is believed to be achieved through sacrifice, risk taking, and hard work rather than by chance. So basically, just summing up, saying anyone can come here and make it basically through hard work and some sacrifice and taking some risk through investments. And it's not probabilistically, not just like this rolling of the dice. It's like we're actually can make this happen. Anyone can make it here in America. So before we go any further, I'm going to throw it to you guys based on that history and the kind of the backdrop there of the definition. What do you, just your first kind of thought, like by that definition, is the American dream dead or unattainable now without us going into stats?
I love that you defined it, Matt, because my head, and when you raised that question, immediately I was like, well, what's your definition of the American dream? Because I feel like the American dream gets just used for a lot of things now.
Just a term, yeah.
Home ownership is the American dream, owning your own business, the American dream, getting rich, the American dream. I'm like, so what actually is the American dream? Because I feel like it's taken on the life of its own, and now people just use it whenever they want to, use it, basically back their point. They're going to say it's the American dream. But in that specific definition, I would say that it's probably not dead, right? Like there's still that opportunity. There's still that ability to have upward mobility, and there's still a lot of opportunity that exists. So in the definition of, as you've described it, what the American dream is, it kind of goes in contrast to what we talked about last week, because with home ownership, it feels different, right? It's harder than it once was, but the ability to still be successful, I don't think that's dead in any way, shape, or form. Sorry.
Yeah, no, I agree. As far as that definition, my first thought would be if you define it like that, the way they do it in Investopedia, I think it's still very much alive. We can talk here for a few minutes of maybe how it's changed, but Rabih, I want to get your thoughts.
Yeah. Here's the perspective of the immigrant who came to the US, in search of this American dream. No, it's alive and well. I think we do a big discredit once we reduce the American dream to monetary gain. Like a big discredit. Like from my perspective, it's still life, liberty, and pursuit of happiness. And, maybe in the 21st century, coin term of it, like upper social mobility, sense of security, individual liberty. They are there in the US. And I think the big part of it is that it can happen due to skills and hard work and not due to luck. And this is what's important. Like from an immigrant's perspective, if I'm not coming to the US just to make money. If I want to make money, there are so many other countries that even have better opportunities to make money than the US, believe it or not. But are they accompanied by rights, by a sense of belonging, by a historical journey and a story, or are you just there to make money in a certain land and leave? It's much bigger than that. And I don't know, firsthand experience, the American dream is alive and
you're living it
to be protected. So it's passed on to other generations for sure.
I love that you brought that perspective, Rabih, and such a different perspective than what Taylor and I can bring truly from an immigrant status, or, that you just, this is not that long ago. You got to the US and achieved citizenship, and you are living embodiment of how it can work. But I love that perspective of saying, because I think this does oftentimes get boiled down to monetary. Like even everything in this article is really about, and we can highlight some of the things they say, of like how it's possibly changed and why it is valid that some people might say it's not what it used to be, but it all comes down to monetary. I love that you just brought up, like, it doesn't have to just be like, if it's just like you come to America to make more money than everywhere else, well, that may or may not be the case anymore. There's people living in freaking Bali on their laptops making a ton of money doing things. Like the globalization and the technology and innovation has changed. You don't have to be located in any one area and be like, I have to be there to make the money. So I love that you just said that. It's a really good perspective.
Yeah. And Matt,
so we all, oh, go ahead, Taylor.
I'm going to say, can you read the definition specifically again about, like, it was something about
You want to read it again?
Your definition of success, right? Because the way I heard that was like, it is kind of subjective, right? Like your American dream is different than someone else's, right? And I think if anything that we've done a disservice to ourselves is like, I love having Rabih on here because that's just such refreshing perspective to have. But I feel like talking to people who grew up here and were born here and raised here, like their perspective of success is the biggest change. Like the American dream has not died. It's just their definition of what success looks like has changed and has elevated to a way that's a lot. It's harder to obtain that level of success that they're seeing on social media and through celebrities and influencers on an everyday basis. And I think that's where most of the discouragement comes from, is from people moving their subjective view of what their definition of success is.
Totally. That's a really good perspective. And you're totally right. In the actual definition, it says the words can attain their own version of success in society in which upward mobility is possible for everyone. So that's key there, that their own version of success. And as we said last week, and I love that you brought it up again, Taylor, that a huge part of this is that expectations of what a good life is in America have grown far faster than the actual progress in reality. Progress in reality has massively progressed. Like we've only seen growth. Every generation has it better off than the previous generation. That is the hallmark of a growing economy and society, whether that be like actual monetary or even just like today's age, the access to things we have now. Go back 30 years ago. Like, didn't we talk about Millionaire a couple months ago? Maybe like the idea of being a millionaire today and inflation and what it actually means. A millionaire in like 1990 is actually being like a multimillionaire today. It's like worth like 2.5 million or whatever. But you'd much rather have $1 million today than you would 30 years ago because of the things we have access to that people didn't. So I think that's also something people don't necessarily think about is the actual access to things that you didn't have, again, even 20 years ago with the innovation that we have. So this is a whole other episode. We're not going to go, we need to wrap this up, but it sounds like, again, the fundamental thing we're saying here is we don't believe it's dead. I think the message here being that it's changed. And I think that's kind of the point. He goes through a ton of data here. I want to highlight a couple of things of showing some empathy for people who are saying it's dead. I think one of the true things that it is actually happening in the data, the gap is widening between the haves and the have-nots. And I think that's a problem. So I'll give you one data point here. He highlights that middle-class wages are stagnant. So middle wage workers' hourly wage is up 6% from 1979. Low wage workers are actually down 5% over that same time period. High wage workers, their income's actually up percent. So I think the gap is widening for sure between like the high wage, high earners, wealthy people and the middle or the lower class. I think that's becoming a problem, which I think certainly needs to be identified. The other thing he brings up that he has data to back this up, price changes for essentials has dramatically increased since 2000. So he shows a lot of data here from 2000 to 2022, things like hospital services up over like 250%. Increases. College and tuition, we know, although flattened recently, college textbooks, medical care, child care, food and beverage, housing, like all these things, overall inflation of those key categories is like 74% over the last 22 years. So what's interesting is we talk about things like technology. So cell phones, TV, toys, computers, new cars, clothing, all down actually, or new cars are like slightly up, but clothing, cell phones, computers, technology, all that is TVs have gone negative 80%. And like the cost of TVs and things like that is way low. But essential services, things to live, have been nothing but have gone, have only gone up. So I think if you think about this of like the lower end of the curve when it comes to wage earners, you've got stagnating wages and you've got cost of essentials to live are up 74%. So I guess I want to highlight that to say, have some empathy of saying there is a large group of people out there right now that are feeling this and probably saying, yeah, there's no way this is still alive. Like I'm spending so much more money than my parents used to on all these things and I'm earning less in real time. What are you guys' thoughts on that? Any thoughts of kind of that side of things?
Economic prosperity isn't what is guaranteed in the American dream, right? It's the access to opportunity and to make a fair, reputable wage that preserves your honor is what is guaranteed, right? If maybe I'm going to sound a little bit harsh, but if the environment around you has changed and the way you make money has become different, and now you feel that the economy is slipping under your feet and you're not there anymore, well, this is a call to action for you to adapt and thrive in the new infrastructure. Just be grateful that there's still rules and regulations that uh, provide you with the right to excel in it rather than you being locked out. I know that this country has lots of history, but on the large arc of time, it's still in a much better position.
Taylor, any thoughts on that?
No, I just, it's tough. I mean, I feel like there's a lot of prosperity and there's a lot of people that are struggling. And it's easy to say to someone who's struggling, like, why don't you just do this, this, and this, right? Why don't you just pull yourself up by your bootstraps and do it, right? And the problem is just like some people just don't understand how it's done or how they can get there, right? And you're kind of focused. I mean, this is just such a conversation. So, you're kind of opening up a can of worms here, but I love the word empathy that you use, Matt. There is a lot of people out there that are working really hard, right? And they are single parents with multiple kids and they're doing everything in their power to work hard to just make it and earn a living and get by. And they don't have the mental capacity or the extra time and energy that it requires to move yourself from one level to the next. And it's just okay to be empathetic to that, right?
Yeah, totally. And the main point of this at the end of the article, and I think what we're saying here is it's not dead. It's still very much alive. I think the definition of how it's applied is possibly changing or what it actually means. But I think the core being you get to define that core of like what success is. I do want to wrap up really quick. Just again, one more data point, really, because we talked last week about home ownership. He highlights that as a big piece here. So home ownership skyrocketed really post World War II. From 44% in 1940 to 62% in 1960. It peaked in 2004, 2005, around 69%, and then today around 66%. So still a lot of people own homes. And we talked about the housing affordability being a part of this last week. He does give some numbers to this that the historically, the average price of a house in the U.S. has been around 5 times the median household income. As of 2024, the typical U.S. home is now 7.33 times the median household income. It is certainly higher, no question. But also, what he mentioned, I'm glad he's confirming what we talked about last week. The size of home that we expect, Taylor, that comes back to what you were saying. The expectation, homes have done nothing but get bigger, basically since 1973, while our actual family size, it's literally the chart is like they're crossing over and going exact opposites. So our family sizes are getting smaller by quite a bit, but our homes are getting much larger. So it's kind of both, right? Like there's expectations of what we think it is. There's some real data that says there are some people actually struggling for sure. It's like anything, to your point, Taylor, this is a big can of worms, is a huge discussion, maybe like a whole separate like after hours podcast. But I think it's a worthy discussion to be talking about, that it's not that simple. It's not like first define what you mean when you say American dream, and then you hear a lot of this like it's dead, this isn't, like it's no longer a thing. Like it absolutely is, even if it is changing. Let's give final words to you guys. Rabih, anything you want to add to this or anything else we've talked about?
No, I agree. I think we covered all bases, not to get too controversial.
I
Perfect.
honestly would love to dive more into this article and these numbers on like a full-fledged podcast. I think there's just a lot of meat on that bone.
Yeah, it'd be cool to do like a whole separate kind of long form discussion about this. And I truly do like such a good topic to have Rabih involved in because of the perspective he brings compared to us being born and raised here. I think we can take a lot of things for granted or just kind of have like blinders on of like what it actually is like to come from another country, completely different country on many levels. Rabih, I don't need to tell you that, compared to the US. So it's just a unique perspective. I think it would be cool to like maybe do a long form on this, but we went way over, guys, a little bit longer than normal. Hopefully, maybe editing can clean this up a little bit, but hopefully helpful as always. We're just trying to add value and spark thoughts and questions and hopefully add some value in education. So we really appreciate everyone listening. We have the summit coming up. We've obviously been hitting that a lot, but what we want to talk about actually to end this is, if you can't tell, we love these conversations. We love education. If you have a study club, if you have a group of dentists that you want us to speak at, we speak all over the country at different events and study clubs. We would love to be a part of
I've been
helping you out.
I've
You
been to
what?
Alaska for a study club.
Yeah, Taylor went to Alaska for a study club. I was in Virginia earlier this year. We love doing these things and adding value if any way we can to the dental space. Love these kind of small group type things. So if you have any interest in having us come speak to a study club, you can go to dentistadvisors.com/study. We have different topics we can talk about. We can customize something to you as well, but you can fill out a form there, submit, request us to come speak at your group. We would love to do so. So for now, Taylor, Rabih, thanks for being here. Everyone, as always, thanks for listening. That was our 2 cents. Till next time, bye-bye.